Hello everyone, welcome back. This is Nikhil here, and today I want to discuss with you about the various criterias you should know before investing in any mutual fund. Now, if you haven't seen the first part, I would definitely suggest watching that one before this, as that video explains the basics of a mutual fund. I'll attach the link to that particular video in the description below. Now, one of the major reasons for this particular topic is purely because a lot of people recommend you to invest in mutual funds. But all of us, we make the same mistake where when we start investing in any fund, the first thing that we look at is about 2 to 3 years return. If it's around 16% or 20%, a lot of us, we blindly invest into that particular fund house itself. Now, the goal of this channel is to provide the financial knowledge to today's youth, which schools and colleges don't provide. So, if it's your very first time here in this channel and you want to learn more about investing and small tips to grow your wealth in your 20s, particularly in India, start now by subscribing so you don't miss anything out. So, with that said, let's get into it. Now, there are multiple different criteria which you need to check before investing into any mutual fund. The very first thing being that you should know your timeline of investment. Before investing into any fund, you need to understand what is your end goal and what exactly the duration that you want to stay invested and how much risk are you willing to take. If you're looking to invest for a short term, let's say about 8 months or maybe 1 year, or let's say even 2 years, then investing in equity funds might not give you the best result. Equity funds are very volatile, hence look more for debt funds. These normally give you better result than a fixed deposit or a savings account, but at the same time, it's not very high return also. Depending on your goal and your timeline of investment, you need to choose your fund. Now, once you've understood how long are you planning to invest, you need to check what sort of track record does a particular fund actually have. Don't look at a 1 to 2 years return. Check how the fund house has actually been performing over the last 5 to 6 years. Ideally, a 7 years track record is perfect. What are the various sectors which the fund house actually has invested in? And how are these sectors performing in today's market? Make sure you also check who the fund manager is and what kind of experience does he or she have. End of the day, this person will be the one who will be investing your money. You need to understand what's the expense ratio and which the fund house will be charging you. Now, for everyone who hasn't seen the previous video and are quite clueless what expense ratio is, it's basically the fee the fund house charges you for an annual basis for maintaining that particular fund. Absolutely, the fund house will not be doing this for free. They will be charging you a certain amount of money. And this is something which most of the youngsters they don't know. This fee covers all kinds of management fee that the fund house actually requires to perform their day-to-day operations. In India, most fund houses charge between 1% to 2.5% of your total investment amount. You need to understand your entry and exit load. Entry load is basically an entry fee which you have to pay, but from 2009, the entry fee has been stopped across all mutual funds in India. But your exit load is still applicable. So, before a certain duration, if you are selling a mutual fund, the charges applicable is your exit load. The exit load is not part of your expense ratio. So, this is basically done so investors don't invest money for a very short duration. Now, not every fund houses in India charge an exit load, so make sure you check on this. Some funds are open ended where the investor has the option to exit the scheme when and when they want. So, if you're investing in SIP, each installment must complete at least a period of 12 months for you to avoid the exit load. If it doesn't, then the exit load will be applicable. So, always check if there is any lock in period for a particular fund. Compare how the fund house actually has been performing with other funds which are quite similar to it. That'll give you a better understanding as well in terms of an average benchmark how the various funds have been performing. Another way of checking this can be, let's say, in a particular year, your Nifty has grown by 10% and your NAV for that particular fund has increased by 12%. Then, in that case, your fund house has actually outperformed the index. But if your Nifty has grown only by 10% and your fund house NAV has increased by 6%, in that case, your fund house has actually underperformed. When you're checking benchmark, you should check for at least a year. After all, you will be investing for at least 1 year. So you need to make sure that you're investing in the right fund. Now, there are a couple of disadvantages as well of maintaining a mutual fund. A lot of mutual fund houses, they turn out to be quite greedy. They want more investors to invest in them so that they can have their fees. They might not invest your money in the best way because the fund manager doesn't have much experience and the overall returns which you might be getting would also be quite less. So they focus more on getting their income in. Understand that irrespective of you getting your returns or not, the fund house will still get their fees. Everything in regards to the mutual fund depends on the fund manager. A lot of fund managers might prefer to invest only into golden companies or reputed companies in order to ensure that their name is quite good in the market. A result of this might lead to the fund not meeting expectations since the return on such stocks isn't much on a short run. It is very important for you to do your research properly before investing in any fund. Don't just invest in a fund because the last 2 years return was 15% or 3 years return was 17%. That's not how you should invest in a fund. A lot of people make this mistake where they see a previous return and accordingly they expect the same kind of return in future as well. Trust me, that won't really happen. So with that said, you guys, thank you for watching this video. I really appreciate it. If you did gain some sort of knowledge from this particular video, then definitely do hit the like button and make sure that you subscribe as well if you haven't already. I would really appreciate all the support. Also, if you haven't seen the first part, then make sure you click over here to watch that particular video as well. Also, if there is any particular questions regarding this topic, feel free to comment them in the comment section below or drop me a message on my Instagram and I'll try to get back to you as soon as possible. So with that said, see you all in the next video.